I still can't believe Vanguard's recommending this portfolio. It just seems weird to me. It just seems anathema, is that the right word? Antithesis of what Bogle would recommend. I'm surprised by this. You okay? What's up, buddy? What's up, man? Let's dive into this. Point being, my man will come Roger the Dodger. He emails me the other day. He goes, Josh, can you believe Vanguard's he goes, Josh, I watch all your videos. Can you believe Vanguard's recommending a 30/70 portfolio? And I said, apparently, Roger, you do not watch all my videos. And I sent him the link about the video I did on this already back 2 months or so ago. He goes, no, this is the update about what they recommend. And it's still 30/70. Oh, I got to give the boys water. Anyway, let's give the boys water. I'll take you with me. Pablo needs some water. Pablo is thirsty, so we got to make sure he gets his water. Anyway, so he said, this is updated. Oh boy, now Finney wants to come inside. All right. And I said, well, send me the link. He sent me this link, and I said, okay, well, let's look at it. And this is just, it's amazing to me. So check this out. So this is from Vanguard right here. Bonds remain in favor in time-varying model portfolio. So this is their 10-year recommendation, 10-year portfolio. And this is July 23rd, 2025. As a result of June's broad equity rally, and this is, remember, it's June, what we were talking about before, where I did the video where Vanguard's recommended 30/70. So Vanguard recommended 30% in stocks and 70% in bonds. Okay? And they're actually doubling down here. As a result of June's broad equity rally, our time-varying asset allocation portfolio has further expanded to bond allocation. Fixed income accounts for 70% of the portfolio and increased to 3 percentage points from the previous month. The conservative stance relative to a 60/40 benchmark portfolio reflects a historical low global equity risk premium, which continues to favor fixed income over equities. The portfolio largely maintained its positions within asset classes. In the second quarter of 2025, the U.S. stock market surged by 11%, driven by large-cap tech stocks. Robust earnings and resilient consumer demand also boosted equities. See, this is the problem. I mean, this is like market timing, man. I get if it's a short-term thing, but we're talking 10 years, Vanguard. Your time-varying, what the hell they call it? Time-varying asset allocation. They're looking at 10 years. They're still, this is crazy to me. Developed market outside the U.S. rallied by 13%, supported by the ECB's bank rate cuts. Stronger than expected Asian export data. Blah, blah, blah. Okay. The TVAA strategy is built on the framework of the Vanguard asset allocation model, driven by the Vanguard Capital's Markets model. It provides a model portfolio that optimizes for higher expected risk-adjusted returns over the next decade. And so we're going to scroll down here, and here's the benchmark. 39%, we'll just say 40% U.S. stocks, 20% international, base 30% U.S. bonds, 10% international. That's their benchmark. The TVAA, the time-varying asset allocation, is 30% equities. Let me get it water here because it's hot. I gotta get that vitamin. Was it vitamin D, right? I need that vitamin D on my beautiful, beautiful pale skin. Because remember when during COVID, the pandemic, they're like, stay inside, stay safe, stay inside. You're like, fresh air and sun is good for you, freaking fools. Anyway, so they got right here, they say developed markets 8%, emerging markets 2%, U.S. value. I mean, this is like picking, I don't get it. I don't get Vanguard's doing this. Aggregate bonds, U.S. 37%. You can see all this right here. Anyway, time-varying portfolio allocations were determined by using the Vanguard asset allocation models. So here are the portfolio characteristics. Their 10-year expected rate of return is 5.5 for their 30/70, which is only 5.2 for the 60/40. Their 10-year annualized volatility standard deviation is 5.9 for theirs versus 9.2 for the benchmark. Expected maximum drawdown is only 3.3%. I don't even, how do they get that? How did it get that? 3.3. You take this, our volatility 6. We times that by 3. That's 18. 3 standard deviations. Subtract by 5.5. That's 12. Yeah, 12.5. That would be your expected maximum drawdown within the bell curve of 3 standard deviations. It's just weird to me. Probability of underperforming the benchmark, 47%. So basically what they're saying is we think over the next 10 years, a 30-70 portfolio will not only give us more return, they'll do so with less risk. I'm stunned by that. I'm just like, what? I'm just sitting there thinking, that's a 10-year time frame. Bonds, you know what you're going to get with bonds. This is just as simple. Bonds are going to give us, what's the 10-year treasury right now? 4? So what the hell's going on here? All right, so bonds. I clicked on something. Right now, the 10-year treasury is at 4.015 or 051. That's what you're going to get in bonds. No more, no less over the next 10 years. You literally buy a 10-year treasury bond today, you get 4.051. No more, no less. And so there's, and they're thinking they're going to get the stocks then, they're going to get 4%. And so the other, essentially 30% will be stocks, will give us the other 1.5%. That just seems weird to me. And I'm especially thinking, this is Vanguard. This isn't freaking Jeremy Grantham. I wonder if a bunch of Jeremy Grantham guys came over to Vanguard, because Jeremy Grantham's been negative for a long, long time. Foolishly, actually. I'm stunned by this. It's weird. Now, I get it. If you're a conservative investor, you're like, look, I just want to protect the downside. That makes sense, but they're not even saying that. They're saying we expect the upside will be more in our 30-70 than a 60-40 with less risk, with a maximum drawdown of 3 point. My mind explodes here. I don't get this at all. Vanguard calculations are based on the Vanguard asset allocation model using return projections from the VC Vanguard Capital Markets assumption. I don't care about the freaking Sharpe ratio. Expected maximum drawdown is a median peak to trough drop the portfolio value in 10,000. How is that the median in 10,000? The median. Okay, I guess that. Well, okay, the median. Because I'm using the 3 standard deviations. I don't get it, man. Bogle has got to be spinning his grave right now saying, you're going to tell people who have a 10-year time frame that they should be 30-70. And when I say 10-year time frame, maybe if you're 80 years old, sure, but even that I say, I get it. I guess if you're expected, no, I don't get it. I guess if you got 10 years left to live, this would make sense. But if we're freaking 5 years out from retirement and 5 years into retirement, that's a 10-year time frame, you're going to tell me to be 30-70? If you're only 55 years old, so 5 years out, you retire at 60, you got 5 years before Social Security, Medicare kick in, then what are you going to do next? Well, we'll have to see what the equity markets do. If the equity markets are low, in terms of valuations, we go higher. Well, that just seems like market timing to me. I don't get it. All right, God bless. Love your thoughts. So, by the way, it's my Boston Bruins. Go Bruins. Hockey has started. We're going to win the cup this year, baby. I'm going to go see a game. I don't care what anybody says. We'll see you.